If you went to university in Australia, there's a good chance you've got a HECS debt sitting in the background of your life. Maybe you know roughly how much it is. Maybe you have no idea. Maybe you've been ignoring it completely. Either way, by the end of this video, you're going to understand exactly what it is, how it works, and what your real options are. Let's get into it, mate. G'day, and welcome to Mate Invest, the channel where we break down Australian money topics in plain English. Quick disclaimer before we start. Everything in this video is general educational information only. Everyone's financial situation is different, so always speak to a licensed financial advisor before making any big money decisions. Alright, let's talk HECS. What is HECS debt? So what actually is HECS debt? HECS stands for Higher Education Contribution Scheme. You'll also hear it called HECS-HELP. It's essentially the Australian government's student loan system. Here's how it works in simple terms. When you enroll in a Commonwealth-supported university course, the government covers most of your tuition up front. You're only responsible for your student contribution amount, and you don't have to pay that up front either if you don't want to. Instead, that amount gets added to your HECS-HELP debt, and it just sits there until you start earning above a certain income threshold. Now here's something important that a lot of people get wrong. HECS debt is not like a regular bank loan. There's no interest charged on it. But, and this is the part people miss, it is indexed to inflation every year on June 1st. What that means is your debt grows in line with the cost of living. In some years, that indexation has been quite significant. For example, in 2023, the indexation rate was 7.1%. That was unusually high due to inflation at the time. In other years, it's been much lower, around 2 to 4%. So it's not interest, but it's not completely frozen either. As of 2026, the repayment threshold, meaning the income level where you start making compulsory repayments, sits around $54,000 per year. Always check the ATO website for the exact current figure, as this updates annually. So how do repayments actually work? Once your income goes above that threshold, your employer automatically withholds a percentage of your salary and sends it to the ATO, similar to how income tax works. The repayment percentage scales up with your income. The more you earn, the higher the percentage taken. For example, and these are approximate figures based on current ATO rates, someone earning around $60,000 might have around 2 to 3% of their income going toward HECS repayments automatically. Someone earning $100,000 might see around 7 to 8%. These figures come directly from the ATO, and we'll link the exact page in the description below so you can check your own situation. One thing that catches people off guard: these repayments happen whether you feel ready or not. There's no opt-out once you're earning above the threshold. It just comes out automatically. The good news is, you never pay more than you owe. Once your debt hits zero, the repayments stop. And if you never earn above the threshold, for example, if you work part-time, take time off, or move overseas, you technically don't have to make repayments at all. Although moving overseas has its own rules now. The ATO introduced overseas repayment obligations in 2017, so that's a topic for a separate video. Now let's talk about how HECS debt actually affects your day-to-day life, because there are some misconceptions here. Does it affect your home loan? This is probably the most common question we get. The short answer is, yes, it can. When you apply for a home loan, lenders look at your income and your liabilities. Your HECS repayments reduce your take-home pay, which means it reduces your borrowing capacity. It doesn't show up like a credit card debt on your credit file, but lenders do factor in your compulsory HECS repayments when calculating what you can afford. How much it impacts you depends on the size of your debt and your income level. A mortgage broker can give you a proper picture of your specific situation. Does it affect your credit score? No, HECS debt does not appear on your credit report. It won't directly damage your credit score. What if you can't pay it off? If your income never consistently reaches the repayment threshold, your debt just sits there. It won't be chased like a personal loan. However, the indexation each June means it can grow over time if left untouched for years. This is why understanding your situation early matters. Strategies to pay it off. Alright, So what can you actually do about it? Here are a few strategies worth understanding. Remember, what's right for you depends on your personal situation, so take these as starting points for your own. Strategy 1. Voluntary repayments. You can make voluntary extra repayments on top of your compulsory ones anytime through your MyGov account linked to the ATO. This reduces your balance and means less indexation hits you each June. There used to be a bonus for making voluntary repayments, but that bonus was removed in 2017. So today, the main benefit is simply reducing your balance faster. Strategy 2. Time your repayments before June 1st. Since indexation applies on June 1st each year, some people choose to make a lump sum voluntary repayment just before that date. The logic is simple. Reduce your balance before indexation is calculated, so the indexation applies to a smaller amount. Whether this makes sense for you depends on your cash flow and what else you could do with that money. Strategy 3. Weigh it against your other financial goals. Here's where it gets interesting, and this is genuinely a personal decision. HECS debt has no traditional interest, just indexation. So mathematically, some people argue you're better off investing spare cash rather than aggressively paying off HECS. For example, if indexation is running at 3% and you invest in a diversified portfolio returning higher than that over time, you could potentially come out ahead. But markets go up and down. Returns are never guaranteed, and everyone's risk tolerance and life goals are different. There's no universal right answer here. Some people sleep better with zero debt. Others prefer to invest. A financial advisor can help you work out what makes sense for your specific situation. So let's wrap this up. HECS debt is one of the most misunderstood parts of Australian personal finance. It's not a scary bank loan, but it's also not something to completely ignore. The key things to remember: it grows with inflation indexation every June 1st. Repayments are automatic once you earn above the threshold. It can affect your borrowing capacity for a home loan. You have options: voluntary repayments, timing strategies, or focusing on investing instead. Always check the ATO website for the most current figures, and always get personal advice from a licensed financial advisor for your specific situation. If you found this helpful, hit the like button. It genuinely helps this channel grow. Subscribe so you don't miss our next video, where we're breaking down superannuation, what it actually is, how much you should have, and whether yours is working hard enough for you. Drop any questions in the comments below. We read every single one. Catch you next Tuesday, mate.